Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Asset Allocation Strategy Update. Today's Friday, November 4th. Well, since our last update, we continue to look at a couple of conflicting signals from different elements of our modeling and observation. From the one hand, we continue to have our major market model and cyclical analysis pointing downward in a bear market. We also have our economic model and recession warning continue to pointing down, and we'll give you an update on that as we have our latest data in from the economic model. On the other hand, tactical indicators have been perking up. We pointed that out in our last update 2 weeks ago. That continues to be the case. Additionally, we're in a very strong seasonal period. In fact, the strongest right around the midterm election time. So here you can see the LTM. This is updated through October 31st, and turning negative at the end of January this year was a good early warning that the market's momentum was rolling over to the downside. It stayed negative now for, ever since that time. If we look at this part of the chart down here, this is one of the specific momentum calculations that we perform that derives the indicator, and you can see that we're now at the lowest level for this momentum in the last 10 years. So we've definitely seen a very strong push to the downside with the momentum turning down. If we bring in more history on this indicator, we could see that other times that the momentum reading got this low only occurred during the two other major bear markets over this 27 years that we're looking at in history, the 2008 and then the 2000 to 2002 period. So if we look at that from a historical perspective, during those bear markets, when the momentum pushed down to the same level or similar level that it's at today, we were certainly well into the bear market, but there was significantly more to go to the downside. In 2008, it hit the same level right around September of 2008. Right, so if we look at September 2008, still it doesn't look like it there, but a good amount to go to the downside, maybe to the tune of another 30% for the market to potentially drop. If you remember, these were 50+% drops in the market back in the 2000 to 02, 07 to 08 bear markets. And similarly, if we look at 2001, when we got down to a similar level from a momentum perspective, it was in May of 01. And here again, there was still plenty of room to the downside to go. Now, this particular episode of a bear market doesn't have to follow those two, but certainly those were other times when both the market and economic models were negative, as they are today. So we can use this as somewhat of a guide of how we could expect this bear market to play out. Latest reading on our economic models continue to point to the downside. Here's our weekly leading index that we use to help gauge the economy and to warn of recession. You can see it continues to drop below the zero line. That's the recession warning. Previous times that it dropped below the zero line was a very accurate warning ahead of time of a coming recession. And if we look at the monthly index, we could see really even more evidence of a recession developing. The blue line is the very long leading indicator that tends to flash a warning well before a recession. The red line is still a forward-leaning indicator, but doesn't lead the recession by as long. Both of these are well below the zero line. And if we look at particularly the long leading indicator, how deep into the negative territory it's gotten now, it's close to the low of the 2008 bear market and recession. Really, the only time that this has gone much lower was back here in the 1970s and 80s. Many people are comparing the current economy to that time because that was the last time we had a high inflationary environment. And we could see some similarities to this period in terms of how quickly and how fast these indicators have dropped from positive into negative. That's really a sign, as it was back in the 1970s, that the Federal Reserve was cranking up interest rates very rapidly to try to put pressure on inflation. Obviously, we're seeing them do the exact same thing today. Just this week, there was another Federal Open Market Committee meeting, and they raised interest rates by yet another 0.75% and indicated that there's more to come. So there's an old saying on Wall Street that you don't fight the Fed, and that really explains the boom in asset prices during the global pandemic as the Fed brought interest rates down to zero, flooded the economy with liquidity. It's also causing the reverse effect now where they're raising interest rates. And what's not talked about as much is they're draining liquidity from the economy through selling bonds as opposed to what they were doing during the pandemic of buying bonds. So with inflation running, depending on which measure you look at 6, 8, 9, 10, even up to 10%, the Fed's target is to bring inflation down to 2%. And as it did in the 1970s, to get there, that's likely to cause significant job loss. Now, just today, we had our latest jobs number, and they're still good. The economy is still producing new jobs to the tune of a couple 100,000 last month, according to the latest data point. To get inflation down from where it is to 2%, there are some experts projecting that it would take 5 to 6 million job losses that would be needed and an unemployment rate of 6 to 7%. This morning, the unemployment rate was reported at 3.7%. So if they want to bring inflation down to 2%, there's going to be more interest rate increases. That's going to put further pressure on the economy, and it's going to create eventually some job loss, and we're not there yet. So there's likely more to go. Now, there are some rumblings and a chance that they're going to raise their inflation target, knowing that 2% just isn't doable without a really severe recession. So if they raise their inflation target to 3 or 4%, that would require less pain in employment, but still probably would require job loss and cause a recession to eventually occur. And what's interesting, or at least I find interesting, is after incorrectly calling inflation transitory last year, the Fed is now using the 1970s and that inflationary period as their guide. And why we saw so many frequent recessions during the 70s and early 80s is the Fed went through a period of raising interest rates, and then when they saw a little bit of relief, they started dropping interest rates again. But then inflation came back and they had to raise rates once again, and there were repeated cycles like that. And what that caused was inflation to remain stubbornly high for a long time during the 70s. So if they're using that as their guide this time and trying to avoid a similar mistake, we could expect them to go a little bit higher for a little bit longer, which should put more pressure on the economy. And other things we need to think about is we're in a much different type of economy in 2022, a different era compared to the 1970s. There's much higher public debt. There's much higher corporate debt. And increasing interest rates too high could cause a lot of pressure in certain areas of the economy and put some strain in certain areas. So they have a tough job ahead, and we'll see how they do. I don't think they're going to be able to navigate this in terms of bringing inflation down without causing some additional pain in the economy. So with our market model continuing negative, our economic model continuing negative, we continue to believe that this is going to be a lengthy bear market. However, we are seeing some green shoots develop, and those stem from our tactical indicators and then the seasonality, as we discussed earlier. So let's take a look at our 10-week chart. So here are the percent of stocks that are above their 10-week average price, and you could see at the end of September we hit our low point for the year down at 12%. We're now up into the mid-range here in the 50% range. So there's been a pretty good swing up in the momentum of many of the stocks globally on a short-term basis. We wouldn't be surprised to continue to see this momentum in a short or even turn into an intermediate term type of rally within this longer bear market. Another good shorter or tactical type of indicator is the high-low index. We pointed this one out in our last update too. It also got down to a very low level at the beginning of October at 4%. Now is up above 40%. So this is swinging to the upside, which tells you fewer stocks are making lows, maybe a few more stocks making highs. And we're beginning to see better technicals on a short-term basis. And perhaps that isn't too surprising because we're coming into a very strong season for stock prices historically. There's a long history of midterm year elections to have big drops prior to the election, usually a bottom sometime before the election. So far this year, the markets, S&P, et cetera, bottomed in early to mid-October. There's been an uplift since then, generally speaking. But then there's a good performance period that happens during the election period and after the election period. So we've looked at this chart before, and it's just a good reference point to show all of these midterm elections going back to 1962. You could see each year produced pretty sizable declines from the high to the low during the year. And then following the decline, very sizable rebounds after the low has been in place. So if we just go back to the last midterm election year, 2018, there was a 20% drop in the S&P 500. And once it bottomed, a year later, it was up 37% off of its high. And if we look at all of these periods going back to 1962, we could see that the median drop is 16% during midterm election years. And then 1 year after the correction, the performance is 27% median return in that 1 year period. So let's talk a little bit about positioning in our strategies. Early this year, when our models turned negative, we really didn't know if the economic model was going to turn negative. So our approach there is maybe this is a short bear market. We're going to move to the sidelines, preserve wealth, but then look for tactical opportunities to get back involved. As the year went on, though, the economic models, as you saw earlier, confirmed that we're likely to move into a recession. So our approach changes a bit at that point, where we look for a longer bear market. And we want to change our strategy then, too, because there could be opportunities to potentially profit from declining markets, or there could be opportunities to make investments in certain strategies that are not dependent on a rising market. We would call those market neutral type of investments, like long-short investments or some managed trend following programs that have a good long track record. So we've made some investments in those areas. In the market neutral segment, we're about 27% invested now. And with the inverse or short funds, we actually brought that back down. We had as much as 25 to 30% invested in investments that were designed to move in an inverse direction to the market. We've now brought that down to just 5% because the market has declined for the most part, and we are now in that shorter term seasonal strength. So we don't want to be exposed, to that type of market by being in inverse funds or short. Of course, we're also seeing our tactical indicators, as we pointed out, strengthen as well. So that's another reason why we've moved the inverse investments back to the sidelines at this point. So we continue to hold a lot of cash equivalents and then the market neutral type of investments currently. I want to make one last observation in this update, and that is all year, but particularly recently, we're seeing a big performance differential between the large growth stocks and the average stock. So the Dow Jones Industrial Average, for example, and the NASDAQ 100. NASDAQ 100 represents the large growth companies. Think of Apple, Amazon, Facebook, or Meta, Microsoft, etc. And then this is the Dow Jones Industrial Average. And this is the last 1 month performance. So the Dow's actually up 8 to 9%. Meanwhile, NASDAQ 100 is down 4 or 5 and actually is testing its low once again. A similar look at the last 3 months, and you could see the Dow pretty close to break even, the NASDAQ down 20%. Now, it's no secret coming into the year, our thought was that these large growth stocks had gotten way ahead of themselves and their valuations were exceedingly high. And we're seeing those valuations come down significantly this year. In fact, if we take a look at some of the largest capitalized companies coming into the year and how far they're off of their high, I mean, we could see Facebook or Meta is 74% off of its high. The best one is Apple, and it's still 25% off of its high. So with the S&P only down 20%, and these largest companies, which have the biggest weighting in the S&P, let's say down in the 40% range on average, that really tells you that there's a lot of other companies that have held up better to keep the market averages from dropping this much. But my question is, if we are going into a recession, those value type companies, their earnings are generally tied to the economy. And therefore, the value stocks could potentially drop as well. And that may be kind of the second phase of the bear market. Just speculation at this point, but I think an observation that's worth paying attention to and monitoring moving forward. So that's going to be wrapping up this update. We're looking at some conflicting signals with our main models negative, but short-term things popping up a little bit, and we're in that stronger season. Obviously, the election next week could be a market-moving event as well, and then we'll have the next inflation readings just a few days after that. And I think those two things could be important developments to determine the short-term direction of the market. Generally speaking, you have a strong period into the end of the year and into the following early part of the following year. We'll see if the cyclical and modeling that's negative overrides all of that during this particular midterm election period. Thanks for watching this week. I hope you enjoy a great weekend.